Hello, this video will be about building a rule-based strategy, decoding, investing with logic, not emotion. I wish you to join us in this impactful video series as we demystify the art of investing. Unlocking the power of logic over emotion will guide you through crucial steps, ensuring your rules are finely tuned, paving the way for a winning strategy to conquer the market. In the unpredictable world of investing, emotions often reign supreme, leading to uncertain outcomes. That's where rule-based strategies come to the rescue, an antidote to the impulsive actions and beacon of a disciplined decision making. Discovered a structured method that applies human-made rules, eliminating the allure of buying in excitement or selling in reaction to negative news. Rule-based investing is built on a foundation of strict guidelines, a series of if-then rules designed to dictate your action. The key to success? Having the right rules in place, steering clear of emotional influences that can cloud your judgment. Say goodbye to guesswork as rule-based investing champion decisions rooted in probability, liberated from emotional biases. It's time to simplify, stick to the rules, and let the logic be your guide on the transformative investment journey. Get ready to conquer the markets with confidence and strategic precision. My investment strategy, which could be different from your investment strategy, as you could be a value investor, a growth investor, analytics, but the idea is to have strict rules to investing and trading. My investment strategy is I am a consistent weight of evidence, rule-based, top-down investor trader using analytics, data-driven, and technical analysis with a focus on probability of succeeding strategy. I trade in any time frame, short, medium, and long term, with a focus on risk management, investing and trading with numbers, mathematics, and probability. A rule-based system entails establishing a structured framework to guide investment decisions. Rather than relying on intuitions, emotions, or subjective judgments, a rule-based approach involves a predetermined rules and criteria. These rules serve as systematic and objective basis for making high probability decisions in the market. By adhering to a rule-based system, investors can achieve several benefits. First and foremost, it helps to counteract the influence of behavioral biases such as ego, conservatism, attention bias, and emotion. The systematic nature of rules prevents impulsive actions and emotional reactions, fostering discipline in the decision-making process. Moreover, a rule-based system introduces consistency and repeatability into investment strategies. It provides a clear roadmap for navigating various market conditions, promoting a steady and methodical approach that remains resilient in the face of uncertainties. Additionally, a rule-based approach facilitates the automation of certain aspects of the investment process. By translating decision-making criteria into rules, investors can leverage technology, including artificial intelligence and algorithms, to execute trades and manage portfolios. This not only enhances efficiency, but also minimizes the potential for human error and emotional interference. In essence, the adoption of a rule-based system aligns with principles of intelligent investing. It encourages a disciplined, systematic, and objective approach, mitigating the impact of behavioral risk and fostering a more resilient and consistent investment strategy. Implementing a rule-based system in your investment approach serves as a safeguard against various pitfalls. It shields you from succumbing to blow-up ego, preventing falling into the trap of paralyzing conservatism, mitigates attention-related issues, and acts as a buffer against the tumultuous ride of emotional highs and lows. The intellectual challenge of constructing such a framework is part of its rewarding nature. Crafting a systematic set of rules requires thoughtful consideration, analysis, and foresight. This intellectual engagement not only helps you develop a robust strategy, but also contributes to an ongoing refinement and improvement of your investment approach. In navigating the complexity of this market, the rule-based system becomes a source of structure and rationality, steering clear of behavioral biases that can otherwise impede sound decision-making. A winning rule-based system has three different factors that it must satisfy. Empirical support stands out as the most evident criteria among the 3 points. Your rule-based system must demonstrate its profitability when scrutinizing its historical performance. Examining how the system has fared in the past provides tangible evidence of its effectiveness and reliability in navigating diverse market conditions. Theoretical support, number two, complements empirical evidence, emphasizing the delving into the numerous data sets is crucial. Simply relying on the empirical support might lead to erroneous correlations, instances where data moves in tandem without a substantive connection. Beyond the historical performance, your rule-based system must also align with the theoretical reasoning, ensuring that its principles make logical sense and are rooted in a sound understanding of underlying dynamics, enhancing the overall robustness of your investment approach. Psychological pain in the context, number three, of a successful rule-based system. A winning system not only withstands the test of time, but also the mental challenging adhering to it. The difficulty in adhering to the system acts as protective mechanism. If the system were easy to follow, as soon as it becomes widely known and popular adapted, its profitability would vanish almost immediately. Therefore, the psychological challenge of staying true to the rule-based system serves as a safeguard, preserving its effectiveness over the long term. A rule-based strategy for investing and trading involves making decisions based on predetermined and well-defined rules or criteria. Instead of relying on subjective judgments or emotions, investors and traders following a rule-based approach use specific guidelines to determine when to buy or sell assets. Here are some key elements of a rule-based strategy. Objective criteria. Rules are based on objective criteria such as technical indicators, fundamental analysis, or a combination of both. These criteria are quantifiable and specific, leaving little room for interpretation. Entry and exit rules. The strategy includes clear guidelines for entering and exiting trades. This could involve specific price levels, technical patterns, or fundamental triggers that signals when to buy or sell. Risk management. Rule-based strategies typically incorporate risk management rules to limit potential losses. This may include setting stop-loss orders, defining a position size based on portfolio risk, or using other risk control measures. Backtesting. Before implementing this strategy in the live market, it's common to conduct backtesting. This involves applying the rules to historical market data to assess how the strategy would have performed in the past. Backtesting helps validate the effectiveness of the rules. Automation. Rule-based strategies can be implemented manually, but they are often well suited for automation through algorithmic trading systems. Automation ensures that the trades are executed precisely according to the predefined rules without emotional interference. Adaptability. While the rules are predefined, a good rule-based strategy also have provisions for adaptation. Market conditions may change, and it's important to have a mechanism to update or tweak the rules to remain relevant. Discipline. One of the key advantages of a rule-based system strategy is discipline. It instills in its investors and traders by the strict following predetermined rules. Individuals are less likely to make an impulsive decision based on the market noise or emotion. Examples of rule-based strategy include trend-following strategies, mean reversion strategies, and quantitative strategies. These approaches use specific indicator signals or mathematical models to guide investment decisions. Keep in mind that no strategy guarantees success, and all trading investments carry inherent risk. It's essential for the investors and traders to thoroughly understand and test any rule-based strategy before applying it to the real markets. Sticking to the plan. Staying true to your trading plan is essential for success. Meddling arises from the belief that we are smarter and know more than the trading system. Despite our ability to analyze complex information, cognitive biases often lead us astray. To overcome this, we need a commitment to mechanism. Odysseus, who wanted to hear that the siren song safely, he used to commit mechanism. His crew blocked their ears with beeswax, tied him to a mast, and ignored his pleas, steers towards danger. Similar in trading, a commitment mechanism helps resist the temptation to deviate from the plan. It's a vital tool to prevent emotion decisions and ensure consistency in executing your strategy. Trading systems must be objective. To stay committed, you need an objective trading system. Some systems lack objectivity and rely on discretion. An example is a subjective rule like sell for small losses and hold on to large profit-making positions. This vagueness can lead to redefining small losses when faced with adversity. While not all systems are poorly defined, many rules allowing subjective interpretation. Technical analysts often disagree on chart patterns as their implications. Creating a purely objective system acts as a powerful commitment mechanism. If your instincts contradict a subjective system, you might bend the rule. However, with clear definitions, any deviation becomes obvious, preventing self-deception. Additionally, purely objective systems allow for effective backtesting, providing a robust basis for evaluating performance. Automation. Objective systems offer the advantage of automation, serving as a reliable commitment mechanism. Computers excel at executing clear instructions like buy if the 20-day moving average is above the 40-day. Subjective systems relying on interpretations can't be automated, as computers can't eyeball trends or interpret ambiguous commands. An objective system is one that computers can run through. Manual execution is still an option. Automation becomes crucial for complex or high-frequency trading strategies. However, even with automation, meddling can persist. The degree of automation matters, particularly automation where a human executes automatically generated trades is susceptible to interference. Full automation is more resistant, but emergencies can still be manipulated. Having faith in your trading rules is a key. A fully automated system without trust can be risky, as the temptation to shut it down in times of trouble may arise. Automation supports commitment, but it must be implemented with a self-designed system in which you have complete confidence. What makes a good trading rule? A well-crafted trading system is carefully built from ideas or data. Systematic trading relies on the assumption that the future will resemble the past, leading to the creation of rules that historically work, with the hope that they will continue to do so. There are two primary approaches to finding a profitable rules from the past. Data-first approach involves analyzing data, identifying profitable patterns, and creating a trading rules to exploit them. This method is sometimes referred to as data mining. Idea-first approach involves starting with a conceptual idea, creating a rule based on that idea, and then testing it on historical data to determine its effectiveness. When designing an ideas-first system, the focus is on capturing specific sources of return with the assumption that the source will persist in the future. On the other hand, a data-first system acknowledges the profitability of past patterns without necessarily understanding or explaining them, hoping these patterns will endure in the future. Advantages of ideas first. If an idea works, no further potentially dangerous fitting is required. Any fitting will probably be done in a small subset of alternatives. You tend to get simpler and more initiative trading rules with ideas first. You can construct rules that make initiative sense and with a story behind them. It's easier to classify the trading rule and work out where its profits are coming from. Advantages of data first. There will be a bias with ideas first to testing things that you know will work, either because of market, lore, or academic studies. This is a form of implicit overfitting. With ideas first, it is tempting to try a large number of ideas to find the ones that work. This is definitely overfitting. In data first, all the fitting is explicit, so the degree of overfitting can be controlled. A compelling theory or story does not guarantee that the source of return is repeatable and could give a false sense of security. Clever data analysis might unearth novel strategies that were previously unknown. In my experience, consistently profitable trading stems from carefully research conducted by thoughtful and knowledgeable individuals who aim to understand the source of their profits. On the other hand, unprofitable systematic trading often results from haphazard data mining, lacking consideration for why a rule might have been profitable in the past or may not be in the future. Given my preference for trust and understanding, I lean towards the idea-first methods. This approach tends to produce initiative, simpler, and more transparent rules. Testing a small number of ideas helps minimize the risk of overfitting. It's essential to be aware of the strengths and weaknesses of your chosen method and apply it appropriately. Explainable profit. Understanding why trading rules are profitable is crucial. Knowing the reasons behind past profitability provides insight into the potential for continued success of the possibility of rules failure. When ideas first approach, explaining why a strategy was profitable is inherent in the original idea. For instance, if you tested a trend following rule, you might attribute its profitability to conjunctive biasness explained by prospect theory. On the other hand, with data first approach, explanations follow the fitting process. Your first objective, how a rule behaves, and then infer potential causes. The complexity of data-driven trading rules can make them harder to explain. Seeking explanation introduces a danger, considering the narrative fallacy. A cognitive basis where humans prefer compelling stories, is crucial to recognize that convincing explanations don't always align with statistical scrutiny. To trust a trading rule, having both a compelling narrative and rigorous backtest is ideal. Can be systematized. To transform ideas into actionability strategy, they must be translated into systematic rules. However, not all trading styles suit this process due to subjectivity or data limitations. Yet these styles can be integrated into a systematic position management framework. When When trading rules fail, there are common pitfalls to consider. First, there are the rules that seem effective in backtests but wouldn't have been profitable in the past, often due to overfitting or reliance on forward-looking data. Survivorship bias, underestimating trading costs or overlooking key market elements can be a contributor to rule failures. Additionally, a brief historical data set might miss crucial periods when the strategy would have failed. The world changes. You aim for strategies that prove successful in the past and will continue to be effective. However, what if the behavior of the market pattern you intend to exploit disappears? For instance, if a systematic trader using the same rules dominating the market, strategy relying on relative value might struggle. A large number of similar systems could swiftly correct any mispricing, erasing potential returns. On the other hand, trend followers might have thrived when collectively dominating a market with reinforced price trends. However, during reversals, they could face challenges navigating a synchronized rush for the exit. In ultra-high frequency trading, when computers have significant advantages, human involvement is minimal. Instead of capitalizing on human weakness or market structure, these systems are engaged in an arms race where success hinges on pure speed and anticipating opponents' reaction. Why certain rules are profitable. Whether you're using systematic rules or making discretionary forecasts, it's crucial to understand where your returns are coming from and identify your edge. In the stock market, an edge refers to a competitive advantage or unique factor that gives a trader or investor the potential for achieving consistently profitable results. It represents a method, strategy, or insight that allows an individual to perform the broader market or other market participants over timing. Gaining an edge is about having a systematic approach, valuable information, or a skill that helps in making more accurate predictions or better informed decisions. It's sought after advantage that contributes to achieving superior returns and managing risks in the dynamic and competitive world of stock trading and investing. Technical versus fundamental. Strategies differ in the data they rely on, either using technical or fundamental information or a combination of both. Purely technical rules exclusive use price data. Fundamental data, which is non-price, comes in two main types: micro and macro. Micro data is specific to the individual assets like the yield of a bond or the PE ratio of a company. Macro data, on the other hand, encompasses a broader economic factors such as inflation and GDP growth. Conclusion of Volume 1, Issue 1. I don't hold a strong dislike for certain investment styles and instruments, especially those with negative skews. In fact, around a third of my own trading system falls into this category. I believe in the effectiveness of a balanced combination of trading rules incorporating different styles that perform well in various environments rather than relying on a single alternative. Understanding and managing the risks of your trading system is crucial. Whether you're an individual trader or a professional money manager with clients, it's essential that your stakeholders are comfortable with the expected behavior of your strategy. I also hold a belief that designing your trading systems correctly is more critical than finding the absolute best trading rules. Particularly avoiding the serious pitfalls of overfitting is crucial, and we'll delve into this topic in the next videos as we transition into Volume 1, Issue 2, the tools of systematic trading.